Hi, my name is Ben Ayers. I'm Dean of the Terry College of Business. It is my pleasure to be here with you this morning. I have been traveling the last 2 months doing our Economic Outlook series, spreading great news across the state of Georgia regarding the outlook for the state. This is our monthly Terry Third Thursday. We're at the home of our Terry Executive Education Center here in Atlanta, which is also the home of our Executive MBA and Professional MBA programs. I'd like to thank our alumni board for organizing today's event as they do every month, and also like to thank our sponsors, our corporate sponsor, the Bank of North Georgia, as well as our media sponsors, the Atlanta Journal-Constitution and Atlanta Public Broadcasting, WABE. So please join me in thanking them for their support. I wanted to mention our upcoming programs. Next month we'll have Glenn Lurie, who is the CEO of AT&T Mobility, and in May we are working on a surprise guest, and it is truly a surprise right now, but we do actually have something in the works, so hopefully it will work out for hopefully either May or in June. One of my great responsibilities as Dean of the Terry College is to teach a leadership class on campus, and it's called the Dearland Fellows class. It was a program that was started in 2010 by Doug Ivester. He still supports the program. Each semester we select 8 students for the class, and then in about a week and a half we'll be going down to South Georgia and doing a retreat at Deer Run. And so today we have 2 of our students that are participating in the program, and I wanted to identify both of those. Cameron Harris. Cameron is getting his BBA in marketing, and Austin Summers. So if you 2 will stand up and so everybody can see who you are. So they got the early morning drive from Athens, and they avoided, I think, the accident that was on 85 South. So they were great to get here this morning. It is my pleasure to introduce today's speaker, Dennis Lockhart, and what great timing to have him here. There was news yesterday, not a shock, but there was news. So this is a timely program this morning. Dennis is the former president and CEO of the Federal Reserve Bank of Atlanta, and in that role he oversaw all the bank's activity, including monetary policy, bank supervision, regulation, and payment services. In addition, he served on the Federal Reserve's chief monetary policy body, the Federal Open Market Committee. Prior to his role at the Federal Reserve Atlanta, he was part of the faculty of Georgetown University's Wall School of Foreign Affairs, and he was also adjunct professor at Johns Hopkins University School of Advanced International Studies. He has served as a managing partner for a boutique investment firm and as president of Heller International Group, among other positions. Currently, he is a director or trustee of the Metro Atlanta Chamber of Commerce, the Georgia Research Alliance, and the Commerce Club. He also sits on the advisory board of the Andrew Young School of Policy Studies at Georgia State and chairs the Emory Brain Health Center Advisory Council. He is a California native, and he also served as an officer in the U.S. Marine Corps Reserve and holds degrees from Stanford University as well as Johns Hopkins. And his talk today is on crisis, recession, and recovery, the decade 2007 to 2016, and what a decade that was. So please join me in welcoming Dennis.
Well, Ben, thank you very much for the introduction, and thank you to the Terry College of Business for inviting me. The half-life of any notoriety is short. I could have been the surprise guest in May. The surprise would be, who the hell was that? I don't remember that name. I did retire. I actually forced my staff to use the term step down as opposed to retire 2 weeks ago. So I'm a civilian in monetary policy terms now, just like all of you. And I watched yesterday's events with great interest. And of course, the Federal Open Market Committee. And forgive me if I say we every once in a while. I haven't gotten used to saying they, but they raised the range for the benchmark rate, the federal funds rate to 75 to 100 basis points yesterday. That's only the third move in the 10 years I'm going to talk about this morning, and I was there for 2 of those 3 moves. The issue, I think, that is on your minds, or it should be on your minds, is not so much what's happened, although I'm going to use it to try to explain some of the forces at work in the economy, in my opinion, but the positioning of the economy for future growth. I think everyone in the room is naturally concerned of what's going to happen to me and my business. If you're a student, what's going to be the job market out there, and how's the early part of my career going to go? So it's natural that you're looking forward, but in order to look forward, I think it is, in this case, very valuable to look back over the decade that pretty much represents the period that I was at the Federal Reserve. And if there is a storyline for that decade, at least part of that storyline is cyclical recovery. We have really enjoyed a cyclical recovery. But prior to that, we had a crisis. And that crisis began arguably in the summer of 2007 in the subprime mortgage-backed securities market and spread. I remember the period well because my eyes were wide open, obviously, thinking that I had gotten into a job that was going to be pretty easy, thinking that I had sort of accepted a capstone position that go to a few meetings, make a few speeches, and everything would sail along. And within a few months of arriving, the world began to unravel. And it took us a while to recognize the severity of what was going on. So in that crisis, you had bank failures, you had bank bailouts, you had a lot of government money forced upon banks to recapitalize the banking system. And understandably, I think, there was a great deal of public and political outrage at those actions, and for that matter, later actions that the Federal Reserve felt it had to make. Well, if you were to look at the period from, say, 2006 to 2009, that's basically a representation of what happened in so many ways. You can take all kinds of data and paint that basic picture. Now, for graphs I'm going to show you, I have smoothed out all of the normal fluctuations. Even in a crisis or a recession, the data have a sawtooth kind of character to them. And I can tell you from personal experience, when you're on the field and you're trying to discern what is going on, and you have a down month, then an up month, and then a flat month in any data element, it is very hard to really know what's happening exactly. Only with a little bit of time and a little bit of perspective do you get a sense of it. But that's basically what the economy looked like if you look in terms of overall activity, or for that matter, bank lending, or housing prices, employment. That's a good representation of what happened. That's where I came in. So I know what you're thinking. You finally found the guy that you can blame for the financial crisis, and although Ben didn't go into it in great detail, I've got a kind of interesting personal history of showing up and then having all hell break loose. So I was evacuated from Lebanon during a civil war. I left Iran and moved to Atlanta for the first time after the Iranian Revolution. I was in New York on 9/11. What else? Some of you will remember the long lines for gasoline back in the early 70s. I was in Jeddah, Saudi Arabia, on the other side of that picture. So those of you who want to maybe just ease out of the room now, I fully understand. But that's where I came in, and again, smoothed out if you want to kind of get a story for the call it 8 years after the crisis and the recession. It's one of cyclical recovery, and it brought us back to a a really quite reasonable state of the economy. Let me back up that with a little bit of detail. First, in terms of GDP. Gross domestic product, or total activity in the economy, is 112, 113% of what it was in 2006 and 2007. So we've seen an economy that dipped but has recovered all the lost ground, and obviously a little bit more. And I'd say the number is above 112% today. If you were to look at employment, the economy lost about 15 million jobs in the crisis and recession. Lost about 7.5 million jobs, and has recovered 15, so up 7 or 8 million from the trough. And as you know, just a few days ago, last Friday, we had an employment report. Unemployment, the official unemployment rate stands at 4.7% today. And it's remarkably similar to what it was 10 years ago. The household net worth, households in the United States, because of housing prices and also because of equity markets, lost, I think, $35 trillion of net worth, and all of that has been recovered. And house prices had a fair amount to do with that, although obviously equity markets have been strong. So house prices have recouped all the losses that we saw in the 2007, 8, 9 period. And then finally, probably substantially because of house prices, it has a big effect on consumer attitudes. Consumer confidence is at a very high level. It, in recent months, has been at the highest level it's been in 15 years. So consumer confidence is right now very solid. We are a consumer-driven economy. 65 to 70% of the economy is driven by consumer activity. So where the consumer's head is has a lot to do with how strong the economy is at any given time. So, question, are we back to normal? Let me just give you a quick little speech on that. I sort of back away from using the word normal. It suggests that 2006 was normal in some way. I prefer to think of normal more in a kind of conceptual way, and that is that normal represents an economy that is in equilibrium, an economy that it has an inflation rate running at around 2%, which is the target that the Federal Reserve has for inflation. An economy that is at full employment, and an economy that is on a sustainable path. It's in a kind of steady mode, and those elements, I think, are what we're really talking about when we use the word normal. In that sense, we are returning to normal, but that normal really didn't exist as a prior state. It's more of an idealized sense of what normal is. So we've had a cyclical recovery, but that is only one part of the story, only one plot line. I use the term subplots. And there are 3 other subplots of the history of the last 10 years that I'm building, by the way, to the present, so we can get a sense of what the future looks like. And obviously, one of the subplots relates to policy, what happened in policy. Let me just throw some facts at you, which I think are really interesting. When I joined the Fed in February of March 1st, effectively, 2007, the federal funds rate was over 5%. Today it's at 1% at the top of the range. By December of 2008, because of the financial crisis that we were experiencing, the federal funds rate was effectively at 0. So the FOMC brought the policy rate from over 5% to 0 in a year and a half. And actually it started when we began to recognize the severity of the crisis. So it was really effectively a year to bring that policy rate down that much. One of my most vivid memories is Martin Luther King weekend in January of 2008. Ben Bernanke called a secret meeting of the FOMC. They're secret until the minutes have to come out 3 weeks later, but it was a secret meeting. It was a video conference, and we have all the members of the FOMC in little blocks. We call it Hollywood Squares. He proposed dropping the federal funds rate by 75 basis points. They typically operate in a quarter of a percent or 25 basis point increments. So to recommend bringing the funds rate down by 75 basis points, a very dramatic move, and meant to some extent shock an already shocked world into more positive thinking. And so that was the beginning of the process, really, in January, and by December, effectively 0. When central bankers cannot lower their policy rate below 0, which used to be, until Europe and Japan went negative, used to be the thinking of economists, and certainly in the United States has been the effective bound for the policy rate, then you have to resort to other ways of adding stimulus to the economy. And part of this policy story for the 10 years was 3 rounds of quantitative easing. Some of you will remember that term, QE. And what it amounts to in simple terms is the central bank uses its extraordinary power of creating money, poof, new money, and buys long-term securities, and the buying puts pressure on long-term interest rates with the idea that you're going to keep rates for mortgages, for car loans, for bank loans that can be term loans and therefore longer term, keeping all of those longer term rates as low as they can be in order to stimulate the economy. We went through 3 rounds of quantitative easing over this period, and as a result, the balance sheet of the central bank has a balance sheet like everyone else, grew from about $800 or $900 billion when I began in 2007 to just a little short of $4.5 trillion today. So an enormous ballooning of the balance sheet. Now, everyone in the room took Econ 1 or Econ 101, and you were taught that the growth of money supplies is inflationary, potentially hyperinflationary. The technical point here is we created excess bank reserves, and that money has not translated into high-velocity money out there in the general economy. It still remains effectively on the balance sheet of the central bank. So it's like latent money as opposed to real money circulating and conceivably having an inflationary effect. So that's the policy story. Another, and there's what happened to interest rates and the balance sheet. Another subplot is one that I call secular trends in the economy. A definition of a secular trend is something pretty fundamental that is happening on a persistent basis over a period of time. In many cases, the secular trends that affected this period and have affected the economy to today, all the way up to this time today, really pre-existed the financial crisis and pre-existed the recession. Many of them are tied, many secular trends are tied to demographic change. So in fact, that's probably one of the most basic secular trends. Now, in the economic profession, making a distinction between a secular trend and a structural factor developing in the economy, not always crystal clear. And some of the things that I'm going to show you here in a second, you might consider to be structural factors, but a secular trend may be reversible over time or may not be reversible. And so we could be talking about structural factors or maybe something that is a little bit more benign than really a structural factor. But let me give you a couple of examples of some of these secular trends that have been at work through this period. I'll start with employment because that's always on people's minds. The cyclical factor was actual employment or unemployment. And it, depending on which way you want to paint the graph, it went bad and then has come back to a reasonably good place. In fact, the Federal Open Market Committee participants, for the most part, believe that the economy is very close to full employment today. Operating an economy at full employment is a lot different, and this is an important point that I'll make later, is a lot different than operating an economy that is in recession with high unemployment. And central bank policy has obviously got to be very much aware of that full employment condition. But while we were recovering employment, labor force participation remained on a secular trend of decline. And by the way, that just is a way of thinking of cyclical versus secular. And here you see the labor force participation on the right side of that particular slide. It actually has stabilized recently, and there's been a slight uptick. So maybe it remains to be seen whether the decline will continue. I'm going to argue that it probably will continue because of some fundamental demographic factors at work in the economy. But we recovered employment while we were losing participation. Other factors related to employment, there's a concept called labor force dynamism. Think in terms of the geographic mobility of workers, the normal job destruction and job creation that goes on in the economy, the hiring patterns, for example. It's more of a dashboard idea, but labor force dynamism has been on a secular decline for a number of years preceding the crisis and the recession. Even wages looked like they were, if not in decline, even wages until recently at least were very stagnant throughout this period. So we were seeing a comeback in employment, but at the same time the wage picture seemed to be dead in the water. Only in recent months have we begun to see a rise in various measures of wage pressures. Turning to, and that's the stagnation period that I referred to. Turning to maybe putting a bigger lens on this, looking at growth, GDP growth. We've seen that on our per capita basis recover, but at the same time, productivity growth has been in secular decline. This is one of the biggest issues we're facing in the economy, is the growth of productivity. And the debate around it is quite interesting. There's a professor named Robert Gordon at Northwestern University. He's written book. It will help you go to sleep at night. It's about this thick. It's on my bedside. And I don't know if it's a function of being a crotchety old professor or pure intellectual objectivity, but Professor Gordon argues that we are in a technology trough, that there is no transforming technology on the horizon that is the equivalent of the coming of electricity or the computer or the internet or whatever that will give a real surge to productivity, a real game-changing form of technology. That is his argument. He's in the school that are viewed as technology pessimists, and therefore his argument is that he sees nothing that's going to change that productivity growth trend and turn it around. And as I will argue toward the end of my talk, this is a really important question if we're going to achieve growth better than the moderate rate of growth that we're currently experiencing. Finally, housing is another example of a secular trend on the right-hand side, household formation, opposite a cyclical recovery on the left-hand side of this. And so it's interesting, household formation has been in secular decline. Obviously, that's partly a demographic thing. It's also related to the preferences of the millennial generation. So I've given this talk a couple times, and I always like to say, the picture on the right-hand side is your kid living in your basement. And I'm told that the number of young people still living with their parents in the kind of figurative basement is as high as it's been since the 1940s. So here you have again, another secular trend that seems to some extent to be offsetting a cyclical recovery. The fourth subplot is one of headwinds. I'll define a headwind as a temporary development that has a suppressing effect on economic decision making. And if you think about the last 10 years, one way of summarizing is that there always seemed to be something developing that was slightly scary. So you will remember the fiscal cliff and a couple of fiscal crises where the government shut down in one case for a few days. And that would have some effect on hiring or some effect on decision making by businesses in terms of investment. The slowdown in China, the Greek debt saga, the weakness of Europe in general and the weakness of European banks, the decline in oil prices. Last year, it was Brexit and the election. And it seemed that every year there was some development, geopolitical or political or even economic around the world, that gave pause, that sort of slowed the willingness of businesses to hire or invest. It also had an effect on policy decision making. So the FOMC now, but I was part of it, would be looking at the outlook and saying, well, the outlook looks such and such, but on the horizon are these issues that if they go very, very badly could really change the trajectory of the economy. So it always seemed to be something. What is it this year? The French elections, yesterday the Dutch elections, the prospect that populism in Europe will unravel the EU, which I think would shake the world if the EU began to really be dismantled as a government structure in the world. So those are the four storylines for the last 10 years. Before I get to really talking about the positioning of the economy for the future, let me mention one other thing that has developed. It was on the front page of the Wall Street Journal this morning, and that is that over the last 2 to 3 years, economists, including Fed economists, including the economists I worked with at the Atlanta Fed, have progressively downgraded certain estimates about the economy. One way I like to explain it is we have lowered our estimate of the metabolic rate of the economy. First, the long-run potential rate has been progressively estimated lower. Secondly, the actual forecast reflecting another secular trend, predominantly, another secular trend being the weakness of business fixed investment. Those forecasts have been downgraded. And thirdly, this is a little bit more arcane, an estimate of the neutral interest rate or the equilibrium policy interest rate. This is the rate that would be neither expansionary nor contractionary. It would represent an economy that is at steady state, and that's where the policy rate setting should be. In a manner of speaking, it would be an economy that is normal, to use my earlier explanation. And we have downgraded that rate as well over the last 2 to 3 years. It wasn't too long ago that that was estimated to be 4%. So that would be a 4% federal funds rate. Now, yesterday, if you look carefully at the communication that came out of the FOMC, it is viewed to be 3%. That's the rate where the FOMC would stop in a series of interest rate increases. And the key point is, with all of this, is that the prevailing view of the overall metabolic rate of the economy has just been downgraded. And here you see tough chart in some respects to understand, but all those yellow lines are downgraded forecasts. So you have potential forecasted GDP growth in the neutral rate. So why? Let me put it, in fact, I'll put it in more personal terms. In March of 2007, the unemployment rate in the economy was about 4.5%. The inflation rate in the economy, the Federal Reserve has two objectives, employment and inflation, was about 2.5%, using the same measures that the committee still uses. Today, the unemployment rate is 4.7%, and depending on how you measure it, the inflation rate is a little bit below 2%. But the conditions are substantially the same. In 2007, when I joined, the policy rate before the crisis was at 5.25%. In similar conditions today, the policy rate is at 1%. How do you explain that difference? Well, I think part of the explanation is in these earlier slides that show you secular trends at work in the economy. And one of the fundamental secular trends is the influence of demographics. We all know that we have an aging population. The age distribution in our society is progressively getting older. I would argue that economists underappreciate the influence of demographic change on an economy. I used to tease my colleagues by saying, I got enough economists around here, bring me a demographer, or someone who can tell me something I haven't heard. We have an experiment going, experiment's not the right word, we have a laboratory for a society that is undergoing serious demographic changes and has little in the way of tools to offset that, because that particular laboratory doesn't have much immigration, incoming immigrants, and cannot assimilate people, and that laboratory is called Japan. So I think watching what happens in Japan, or having just looked at the history of Japan over the last 10 to 15 years, is instructive to some of the challenges that we face in the American economy. Well, let me close. We are not in a bad place. We're growing at a moderate rate, between 2 and 2.5%, I would argue. And it's my view that that is likely to be the growth rate going forward. But in the political sphere, we're getting promises, or we're getting at least assertions that the economy is going to grow at 3 to 4%. And that fiscal measures, tax reform, for example, lower taxes, infrastructure investment, and deregulation are going to be the driving forces that produce a 4% growth rate. I would counsel being cautious about that assumption. I don't want to rain on anyone's parade. I don't want to say it's impossible. I would just make the argument that I think in order for the economy to grow at much above 2 to 2.5%, two things have to be dealt with. One, we have to offset the effect of demographic change on our economy. And secondly, we need a surge in productivity growth. Both of those are heavy lifts. Won't say they're impossible, but they are extremely big challenges. So just let me close with this thought. The choice of future that you want to believe in today is not a bad one at all. Choice one is solid growth, 2.5%, a continuation of what we've seen. Yesterday's decision of the FOMC basically validates that medium-term outlook of moderate growth, and the other choice is much better than that. My personal opinion is I would stick with the 2 to 2.5% until proven wrong. But you can view the world better. That's not a bad choice. We're in a pretty good place. So let me end with that thought, and I'd be happy to answer some questions or hear your comments.
And we've got microphones, so if you'll raise your hand, if you want to ask a question, wait for the microphone, and we can get it on video and tape. Thank you.
Good morning. I'm Chris Brown with Synovus Securities, and just want to thank you for coming out here. One of the questions I had, of course, you touched on was the productivity slack in the United States. In the current administration, it looks like we're in an era right now of starting deregulation. So two things is, how much would you estimate that regulatory reform could affect or positively affect productivity in the future? And then also with deregulation and maybe even coming into the financial area or financial industry, is there a chance where there could be a flood of additional treasuries that come out because maybe deregulation of Tier 1 capital for banks and institutions, where they would have an incentive to flood the market with U.S. treasuries and effectively raise interest rates, which would kind of force, I don't know if it would force the Fed at raising up, but it would send, as far as interest rates in the bond market moving down. So that was kind of a 2-point question there.
Yeah, well, let me first, I'll say what I used to say, but for a different reason. I used to say, these are my personal views. They do not represent the views of the Federal Reserve. They don't represent blah, blah. Now I'm just saying, these are my personal views. On the first part of your question, the way I would frame it is deregulation going to be transformative? I don't think so. I think it'll be on the margin, it will produce a bit more economic vitality. And in the financial world, I don't think it's inappropriate at all. I'm not, having been a regulator, I'm not one who's arguing that we should sort of hold off on all this. I think the pendulum swung very strongly to in the financial sector to a regulatory posture, strong regulatory posture after the crisis, in kind of human reaction terms, quite understandable, it seems to me. And now we've had 8 years of recovery, and the financial system is in a much better position, much more resilient, much stronger. I don't think it's inappropriate to see that swing back. It may take some time, however, in its details. The one argument that I would make on the deregulation in the financial industry is that I hope we distinguish between the too big to fail institutions, the what are called SIFIs, systemically important financial institutions, and all the rest. So community banks, even regional banks, are not, in my mind, plausibly systemic. But there are 6 or 8 banks in the United States and many around the world that are systemic, where a failure of that bank could trigger a real contagious phenomenon. And I hope we distinguish between those two classes of institutions as we go about softening some of the effect of regulation. On the question of flooding the market with treasuries, which would mean the supply is greater than the demand, and therefore the prices should fall and interest rates should rise with that. I take a lot of, and we were watching, by the way, a little bit of a similar episode with China selling off its foreign currency reserves, which is a lot of that being invested in treasuries. China has been doing that to try to stabilize the movement of the renminbi. And ironically, they have been trying to keep the renminbi higher, not lower. So a lot of the political rhetoric about manipulation is, in this particular case, getting it technically wrong. But we've been watching them sell treasuries, and the market absorbs it. The demand, global demand for U.S. treasuries is very sufficient to absorb that. So if there were a sell-off, hypothetically, of major financial institutions not having to hold liquid assets to the extent they are today, and therefore they started to sell, I have great confidence the market would absorb that. There is a broad view that there is a shortage of safe assets in the world, and that shortage means there's demand for U.S. treasuries. So I'm not too concerned about that. Yes, sir.
Hey, Dennis, how you doing? Sims Holmes from SunTrust. I just had one question about going back to the labor force participation rate. Starting at 66%, how do you explain it through?
A little louder, please. I'm sorry.
Sorry. Do you explain it through business automation or just aging demographics, or is it just kind of a perfect storm of factors that have led it to decrease from 66 to kind of leveling off at 62%?
If I understood your question, you know, what are the I'm going to paraphrase it. What are the factors that have influenced this, what I described as a softening of the metabolic rate of the economy and the downgrade of some of those forecasts? Again, I would argue demographics is the big one that influences the economy in 100 different ways that we don't pay a great deal of attention to. You mentioned automation, and I do want to use your question to maybe digress to a different point that's very important. If you go back and look at Gordon's thesis that we don't have any transformative technologies on the horizon, you got to ask the question, is digitization and artificial intelligence and automation, which is now being projected at least to be focused not only on do it with your hands jobs, but on jobs that are purely office, intellectually cognitive skill jobs. Financial analysts, for example. Is that going to be the transformative technology that will give us a pickup in the rate of growth of productivity? Remains to be seen. But I would also point out it's a two-edged sword, because if it comes on very, very rapidly, and there's no way to have that not be disruptive to employment. I don't want to be someone, I'm not someone who thinks that the world's going to end because of artificial intelligence. I think that will create new jobs. But I think the whole pacing of job displacement, skill acquisition, and employment of people who are disrupted, there's no certainty that those things will work in sync, and therefore it could be disruptive to employment. In the U.S. economy, when people begin to be fearful of their longer-term employment and their income stream, that's when consumers pull in their horns. And that's when the economy kind of risks going into a tailspin. People ask me, or did ask me often, do you see a recession coming? Recessions have causes. I don't see one in the making at the moment, but if I were to point to one thing, it would be something that would shock the consumer. And I mean broadly shock consumers into being much more cautious. The way consumers were behaving in 2008 and 2009. That's the one thing that could get a recession of some kind started. And I don't see that, but job loss and high-profile layoffs is what really triggers that often. So thanks for your question. I answered a different question.
Rich Casanova here with the Pro Business Channel, just 2 blocks here from here. So now that you're retired, you stepped down.
Step down.
Right. What's next for you? And would you prefer hosting our Atlanta Dealmakers or Georgia Business Radio in our studio? Yeah. Now that you have some free time. Yeah.
There's a book that's appropriate for people like me or people at my stage. It's called The Portfolio Life. And I bought the book recently. And basically what it talks about is you get to a stage in life where you don't do any one thing, but you do 3 or 4 things. And some of them been mentioned in the introduction. Through my wife's involvement with the Emory Department of Neurology, she was a volunteer there for many years. I've gotten involved with Brain Health, the Brain Health Center at Emory, and I'll make a connection to the argument I made about demographics. We have a tsunami of neurodegenerative diseases, dementia, coming with it's a function of an aging population and longevity. And with those, you see the expression of diseases that in earlier generations we didn't face. And one of the last things I did while I was still in office is I spoke to a business group in Washington on the subject of Alzheimer's. And I argued, here's what's going to happen. I don't know how impactful, but here's what's going to happen. We will have people leaving the workforce, adding to the participation problem that I argued would continue in order to be caregivers. And that will fall disproportionately on women. So we can anticipate that coming. And furthermore, the standard of care for Alzheimer's is 24/7 monitoring of your loved one. And there will be political pressure to cover some of that, and the country cannot afford that. So I am concerned about that, but that's one activity. And I'm looking at a business venture, and I'm going to try to keep my finger in public policy in some way. So it'll be a portfolio of things. I doubt my golf game will get any better. Any more?
Morning, Doug Asiello. Thanks for your speech, and thanks to the Terry College of Business for hosting. I wonder if we could talk a little, well, before I say that, I'm surprised that Gordon doesn't think that all those cat videos on Facebook are productivity drivers. More importantly,
Little irony in your comment there.
more importantly and more seriously, I wonder if we could talk a little bit more about inflation specifically. You mentioned the latent cash on the Fed's balance sheet. Is that, and that hasn't had an effect on inflation yet. Is it yet? So is inflation the cat that kind of can get out of the bag? And maybe the more direct way to ask that question is, do you own physical gold?
Well, the answer to your second part of your question is easy. No, I don't own physical gold. I am the polar opposite of a gold bug. Again, since I'm now in private citizen space, I can give you my frank opinion. I think it's a refuge for people who have lost confidence in governance and lost confidence in money. And it's usually temporary in some way. And I think the infatuation with gold, which is a shiny metal, is really a vestige of deep human clinging to hard physical assets. Particularly is nice if it shines. And we have no choice but to run a system of fiat money. So the idea that the gold standard has come back, you're going to be, there's a market for that view, and there will be speakers and books written every year about going back to the gold standard, and it ain't going to happen. So I just don't spend a lot of time thinking about physical gold or worried about or investing in physical gold. On inflation, it has been an interesting situation to be part of for the last 10 years. Inflation has been running below our target for a number of years. Our problem was getting inflation up, not controlling inflation. The Federal Open Market Committee in September of 2012 set an inflation target. We became an inflation targeting central bank and therefore an inflation targeting country. And there's a lot of technical jargon, but we set it at 2% over the longer run, which means that you don't hit it every quarter and you're not perfectly on 2%, according to a selected index. And we have been, one of the reasons interest rates stayed so low is because we threw everything we could at getting inflation to steady state at 2%, and we couldn't get it to come up. Recently, inflation pressures have begun to pick up in encouraging ways. So the FOMC is in an interesting dynamic that they're going to have to manage, and that is the inflation we're seeing is desirable until it isn't. And I don't know what that would be, but the way I used to think of it is I'm comfortable up to 2.5%. I can tolerate an overshoot for a period of time. But if we start heading toward 3% or 4% inflation, then I would get nervous. And that's going to change the dynamic of monetary policy. The decision that was made yesterday was not tightening the economy to deal with inflation. It was calibrating the interest rate to the reality of the economy and the outlook for the economy. Another way of thinking about that is the car got to a cruising speed and needs less fuel to keep going because it has a certain amount of momentum. That's the way to think about what they did yesterday. They just took a little fuel away from an economy that's operating pretty well. That's what Janet Yellen said. But if inflation surges well above 2%, Then interest rate rises will be putting on the brakes, trying to discourage that inflationary pressure. And we're not in that place yet. They are not in that place yet. And I don't think it's going to be a problem. The final thing I'll say on inflation is this is one of the kind of the fundamental things I learned early on. Central bankers know what to do about inflation. The problem that central bankers have is what to do about deflation. And one of the reasons for the nervousness of a low inflation rate is it was too close to that deflationary threshold. So, central bankers know what to do. If inflation rises, you jack up interest rates, and Paul Volcker and bring inflation down. It's when an economy seems to be contractionary and on a chronic basis, the central bankers they have less tools. So I'm not worried about inflation for the near term.
So that works out well with what I was going to ask my name is Chris Kel. What do you think, or before you left, did you run any scenarios for the countries that have negative interest rates and what the impact's going to be once that stops?
Mm-hmm. I used to get the question about negative interest rates, and I always wanted to emphasize, and even though I'm not there anymore, but still emphasize, I think it's extremely far-fetched that we would resort to negative interest rates in the United States. Both the conditions developing, I don't see, and then the use of that policy, I think would be a real last resort. So the way I answered the question when I got it was, gee, it's interesting to watch the experiment going on in Europe and Japan with negative interest rates, and I'm glad I'm at long distance watching it. Because the consequences of that policy for very long are an unknown. It could very well have unintended consequences. You can point to the banking industry, the insurance industry. Negative interest rates could, I don't want to say wipe out, but seriously damage the insurance industry. The pension world is highly affected by low interest rates, and if you went negative, it would be even in worse shape than we have it here in the United States today. So Europe, Japan, undertook a negative rate regime, interest rate regime, out of necessity, to some extent for technical reasons related to what they could do in quantitative easing. And the overall impact that history will write remains to be seen. I'd prefer to be an observer of that, and that's fortunately where the United States is. Ben, great group, thank you. Thanks for the invitation. Good to be with you, thank you.
So Dennis, I have a gift for you. It is not physical gold, but it's worth a lot. This is a sculpture, red and black. Those are our favorite colors, and we appreciate your time with us today. This is for someone who gives an economic speech for about 2 months every year. This was very informative. Thank you very much.
Thank you, thank you, thank you.
We look forward to all of you joining us next month, and we would also love to pay for your parking. So if you have not had it validated, please, on your way out, make sure that you do. I hope you have a wonderful weekend and see you back next month. Thank you.